Hi, welcome to Jason Fan Tips. I'm Jason Ball, and I'll be your home. Quick disclaimer before we get going here: this content shared during this presentation is provided for general education and information purposes only. It is not financial, investment, tax, legal, insurance, or medical advice. No personal recommendations are being made. Nothing presented should be interpreted as a solicitation, endorsement, or guarantee of results. Although I, Jason Ball, do hold the CFP, CLU, and ChFC designations, I'm not acting as a financial advisor, fiduciary, tax professional, or legal representative through this platform. All examples, case studies, scenarios, and examples are hypothetical and intended to illustrate financial principles only. Viewing, viewing or engaging this live stream does not create an advisor-client fiduciary relationship or a client-planner relationship. Always consult your own licensed financial professional for advice specific to your individual needs. And with that, let's get going. And today, what I wanted to talk about was retirement planning for the self employed and taking a look at some of the options and strategies that you can use. And if you don't want to hang around for the whole video, or you can go forward, five key things that we kind of have some takeaways is understanding the retirement plan options. Some self-employed individuals have several retirement plan options, including SEP IRAs, solo 401ks, simple IRAs, and defined benefit plans. And they each have their own benefits and contribution limits. Maximizing contributions, taking advantage of high contribution limits and tax advantage available with self-employed retirement plans. Consider making catch-up provisions if you're over 50. You need to leverage the tax benefits, utilizing tax-deductible contributions and tax-deferred growth to enhance retirement savings. A lot of this depends on your marginal tax rate. Explore Roth contributions and tax-free withdrawals in retirement. Start early and make sure to diversify. The power of compound interest means starting early significantly increases your retirement savings. Diversify your investments across various asset classes, which is a modern portfolio theory to help reduce your risk. Regular review and professional help. Be regular review just your plan to make sure that you're on track and you're seeing where you're at. That's where someone that has a professional modeling software and that has the education and the skills needed to do what you need to do, and working with a tax professional as well might be a great idea. So now that that's kind of off the board, let's get going into this. One of the biggest problems is individuals usually are now in control of their own retirement planning. And so self-employed individuals lack, and I know if you work for a company, you have a 401k, a health plan, your benefits. But if you're your own business owner, you have to put a lot of these together. And if you have to design your own self-employed 401k plan, you're turning to your long-term security, how you want to be able to set it and how you fund it. There's a lot of different strategies there. So this, guys, is basically kind of a simplified retirement planning for self-employed. Some of the strategies drawing from my years in financial planning, I'll break down as a self-employed business owner myself. You'll learn what kind of plans work, what contribution strategies may or may not make sense, and how to leverage tax advantages. So what we'll cover is retirement plan options, contribution strategies, compound interest, saving strategies, and examples for success stories. So first, you need to understand the importance of retirement planning for self-employed. You lack an employer self-employed plan. You may have inconsistent or chunky income. You may have much more complex financial balance sheets because you're not only managing personal balance sheets, but you're also managing your business, and it's also possibly tied in together. So retirement planning may actually take a back seat because you might be focused on this year's tax planning. You might have business, a lot of decisions, how all that's going. But one of the big things is to take a look at this from how does this fit into your overall financial picture as part of your larger plan of your strategy of where you're going. It doesn't matter where you're doing your day-to-day, month-to-month, but what is the strategies you're using and choosing. You also may not know some of the options that you have out there. You may be an expert in the field and you're actually very good at what you do and you may be the best at it, but you may not have some of the financial literacy or been exposed to some of the different ideas. And this is where working with into the nuances, working with someone who is well qualified might have a lot of benefits, a specialist for you. Um, so a well-structured financial plan can make sure that you're, secure in your retirement. If you structured a well-structured financial plan should also take tax advantages such as a SEP IRA, solo 401k. So you have tax advantages accounts that can be put in accounts that have some protections in them because they're tax qualified accounts specifically for your retirement, and they were put in that way by the government, and they have some special provisions to help protect them. But you also, as a self-employed individual, need a lot of flexibility and control for yourself. So, overview of retirement plans. First one we'll look at is a SEP IRA, is a retirement plan designed for self-employed individuals and small business owners. You can make tax-deductible contributions to your employees' retirement savings, including your own or self-employed. Eligibility: any self-employed individual or sole proprietor partnership corporation can set up a SEP IRA. Employees must be 21 years older, have worked in an employee at least 3 of the last 5 years, and have earned at least $650 in compensation. For 2024, the contribution limits to a SEP IRA is the lesser of 25% of the compensation, or $66,000. Contributions must be made by the employer and are based on the net earnings from self-employment after deductions of one half of the self-employment contributions in the SEP IRA. So after you pay your self-employment taxes, figure out how much you have to put in there. There's some tax benefits. Contributions to SEP IRA are tax deductible to reduce your taxable income in the year that they're made, and the tax can grow tax deferred and withdrawals in retirement. The key point when they are taxed as ordinary income when withdrawal. We've also heard of a solo 401k. A solo 401k is also known as an individual 401k or self-employed 401k. Is designed for business owners with no employees other than a spouse. It offers similar benefits to a traditional 401k, but a higher contribution limit for self-employed. To be eligible for a solo 1k, you must be self-employed with no full-time employees for your spouse. The plan is ideal for sole proprietors, partnerships, LLCs, and corporations. In a 2024, the solo 401k contributions combined employee contribution, an employee, you can contribute about 22,500 or 30,000 if you're 50 or older. As the employee, you can contribute into a 401k as both an employee and the employer, so the business tax ID number. The total contribution limit for both employee and employer is 66,000 or 73,000 for those 50 or others. So the solo 401k can be made with pre-tax, reducing your taxable income, or as a Roth contribution, allowing you tax-free withdrawals in retirement. The planned investment grow tax deferred or until withdrawal. We also have a simple IRA, which is a savings incentive match plan for employees. A simple IRA is a retirement plan designed for businesses with 100 or fewer employees. It allows both employees and employers contribution to the plan. Any small business with 100 or fewer employees earns at least $5,000 in compensation during the preceding calendar years can establish a simple IRA. Employers must earn at least $5,000 in compensation in the 2 preceding years and are expected to earn at least $5,000 in the current year. Contributions: employees can contribute up to $15,500 with an additional catch-up contribution of $3,500 for those 50 or other. Tax benefits: once again, employee contributions in a simple IRA tax deductible, reducing taxable income. Employer contributions are also tax deductible as a business expense. Now we get into another type. And so we have a defined contribution plan, but then we have what's called a defined benefit plan. And the difference is you decide how much money you're going to put into the plan, and then you never look back at it as a business. It takes its deduction, it goes off, it's not yours. A defined benefit plan is more of what we consider a traditional benefit plan, and they use some formula that defines to calculate a specific amount or factor your sales history, your day, like 3 times half of your last highest 3 years salary. This benefit is used to calculate your years of service, something that years of service, time of percentage factor, times your average salary might be a factor. And it calculates a benefit that has been paid when you retire. Very different structure and how they're handled. A defined benefit plan is a traditional pension plan that promises a specific monthly benefit, and the benefit is calculated on the accounts. And any self-employed individual or small business owner can establish a defined benefit plan. It is particularly suitable for high-income earners seeking to make large contributions towards retirement. Contributions to a defined benefit plan are determined by actuarial calculations and can be significantly higher than those in traditional retirement plans. The limits are based on factors such as age, income, and desired retirement benefits. Tax contributions to a defined benefit plan are tax deductible, reducing the taxable income, and the plan's investments grow tax deferred until the benefit is distributed in retirement, at which point they are taxed as ordinary income. Defined benefits are much more complex and costly to administer than other retirement plans, and the ongoing actuarial assessments and subject to more stringent requirements. However, they can be highly beneficial to self-employees with high, stable income who want to maximize their retirement contribution. Here we just have a little bit of a table that we put together to look at the features of the SEP, Solo 1K, and defined benefit plan. You can kind of look through here. I have a blog post on this. Most people, small companies are probably going to be better. It really depends on your individual circumstances, and this is once again where you need to go actually run some numbers and what you want to do versus a traditional plan or 401k plan. or a defined benefit plan. It depends on what some of your goals are. And so it's a top level strategy before you kind of look at some of this. So we're just doing some education. Contributions for a SEP IRA current limits are calculated for 2024. And the maximum contribution to a SEP is the lesser of 25% of your net earnings or your self-employment income or 66,000. We also talked the solo 1K, simple IRA. Let's talk some of the strategies. So when you're looking to maximize the strategy, you're looking at two things. How much money am I going to be able to put over here? You're kind of looking at how do I manage my marginal income tax now and in the future, and how much do I want to spend today versus how much I want to spend for my lifestyle in the future. So you're actually, managing a few different things going through this. You need to take a look at budgeting for contributions to set aside a higher portion of your income regularly to ensure consistent contributions. Do you want to do automatic contributions? Is it going to increase earnings? Aim to increase your business income. Maybe you're better off putting more money back into your business than you are putting it into a 401k or into highly funding a retirement plan at a current time. Utilize multiple plans. It might be possible to do a combination of plans, such as a SEP IRA or a solo 401k, to maximize your contributions. Catch-up contributions, importance for individuals over 50. On a 401k, it's 7,500, and a simple IRA, it's 3,500. Here we have a little table here. You have your basic annual contribution, and then if you reach over a certain age, you get to add a little bit more to. They're trying to get people to save enough money to have enough money for retirement. Um, Tax benefits of self-employment plans. Contributions to a SEP or IRA are tax deductible, which means they reduce your taxable income in the year which they are made. For example, if you're $100,000 and you can contribute $20,000 to your SEP IRA, your taxable income increases to $80,000. With a solo 1K for tax deduction for traditional contributions, if you contribute $22,000, $22,500 as an employee, and an additional $20,000 employee as an employee, your taxable income total income would be $22,000, 42,500, and this is an immediate tax deduction to the business. Into your expenses. Simple IRA, understanding the employee contributions and tax implications. Simple IRA, whether matching contributions or 3% of compensation, non-elective contribution. For businesses, the contributions are made with pre-tax basis, reducing taxable income for the year. Defined benefit plan tax advantages. Defined benefit plans offer substantial tax advantage due to the higher potential contribution limits. Contributions are tax deductible, significantly reduce tax deductibles. If a self-employed individual contributes $100,000 to a defined benefit plan, their taxable income is reduced by this. This allows for tax savings while preparing for a well-funded retirement. However, the money, when it is withdrawn, will be taxed as ordinary income tax. The benefits of taxing investments on gains. Tax-deferred growth means that earnings grow in your investment accounts. Interest, dividends, capital gains are not taxed until the funds are withdrawn. And this is one of the things where you've got to understand is are the funds that are being withdrawn from a retirement type plan are coming out as ordinary income. And one of the things you need to look at is if I'm going to take the income and pay the tax on them now, am I going to have a percentage tax rate? What is the tax rate that's going to be paid on a dividend rate on that? And what is my income tax level now? This is one of the areas where effective tax planning needs to be done with financial software for modeling it to kind of get an idea where you're going to be in your expected, because it's a factor of the marginal tax rates, expected growth rates, and time horizons. And as well as the distribution and the sequence of how long I'm going to be saving and how long am I going to be planning to distribute the assets from the account, and what is my income going to look in retirement. So this is one of the areas where you really need to spend a lot of time modeling it out with Excel spreadsheets, going through. There's great software out there that some of the professionals use that can do a lot of this. This is one of the areas where it starts getting a little more complicated and getting into, because small changes in some of the growth rates and tax rates can have big effects on the expected outcomes. We also have the solo Roth. Benefits are Roth conversion or tax-free withdrawals. A solo 401k offers the option of making Roth contributions. Unlike traditional contributions, Roth contributions are made with after-tax dollars, but the income is not taxed when it's pulled out. It's completely tax-free. So leveraging these benefits can In strategizing this, can self-employed individuals can maximize their retirement savings while minimizing their tax burden? And the question is it the goal to minimize tax burden now, lifetime tax burden? What are some of the goals that someone is looking at to do some of this? So here, once again, I have another chart that I put in here to take a look at some of these options of a SEP, solo, simple. The big question is, do you want to defer taxes to retirement, pay taxes now, and what are the expected growth rates and the type of taxes that you're going to be paying? Because you have ordinary income tax, but we also have capital gains tax rates that have a different structure. So this where I really starts getting into, do I want to have some taxable, tax-free, and how is your Social Security benefits and other income going to be looking in retirement? Compound interest and its impact on retirement savings. Compound interest is a process where the investment grows with, exponentially over time. We've all seen it, A equals rate one time. So someone that starts at an earlier age, and this is where we say starting for retirement really makes a lot sooner, because the way I like to think about this once I get out of the math is the faster you can get an asset, an asset earning money and earning that money sooner gives you more income to kick off of that. So it's easier to start at a younger age to start building assets to save for retirement. And I'm sure that's a lot of people that are trying to build your businesses. It's how do I get that income stream, and then how do I keep that income stream to turn the asset to kick off the return that I'm going to be able to live off of. A lot of this is done in the form of an investment, but it's how do I get it up to that amount to be enough to where it can start eventually earning what I make as my income or more than I make from my income in year. And then how much am I going to be living off just interest, or am I going to be drawing that asset down? That is when we start looking into the marginal tax planning in that. And the other question in this is, the majority of people end up in a lower tax bracket in retirement. There are people that do end up, business owners typically may end up in a higher income tax bracket in the long term. So it really depends on your individual circumstances, the states you live in, your incomes, your family, your business, your expenses, and what your expected growth rates are. Saving strategies. Best thing I can say is, set some clear goals of what you want to do. Is my goal to retire sooner and be done with business? Is my goal I want to stay working at my job as long as possible? I want to pay for my grandkids' colleges. Is it, what are the goals to take vacations, to not take vacations? It really goes back to setting your clear, authentic goals that helps drive the strategy of where you're going to go. Make sure to pay yourself first. As business owners, you try to go in, but you need to make sure you take care of yourself. Automatic contributions. Make sure to track income and expenses. Get really good with your QuickBooks, but also have your personal finances in line, and setting goals and understanding your personal finances. Make sure you always got your emergency fund. Personal capital, you can do Mint, you need a budget, Fidelity Retirement. There's Betterment, some great robo advisors out there. I actually like to call those auto asset allocators, because you got two things there. You have auto asset allocators, which is like a Betterment in the auto portfolio, but you also have the tax planning, which is more tied into your CPA, and then you have your retirement strategies of, okay, we're going to do not just doing your taxes here, but what am I going to do to some software to do some hypothetical and forecasting and using some Monte Carlos. And that's where you really need some financial planning software that does tax flow, cash planning. Some people like to do, there's different ones that like to do different projections and how they do that. When it really gets down into taxes, some ways I like to really focus on more of the tax. Personally, I like a software that goes and does more of the tax code, cash planning as I go along, or really building Excel spreadsheets to be able to really manage it. But there's some great financial software out there that does that. Um, once we have in retirement, they talk about diversification, but what does that mean? And in traditional, a lot of financial planners, that basically means I have some stocks, bonds, mutual funds. I've diversified the assets in that, but I also have the bonds. Really, what's to diversification technically means is that assets are negatively correlated, and so you can't be overly diversified. But really, the goal is to have assets that do not behave the same in different markets. If one goes up, another goes down, but you end up with a higher expected return with a lower standard deviation for risk. So there's a lot of things that build that. So when I say, oh, I'm diversified, I just have an index funds, that may not be, if you have all the assets that go in one direction, that's not technically what diversification is meant in the financial system. It might be a diverse set of stocks or a diverse set of sheep, but it's still all sheep, for example, versus having sheep and cows, or sheep, cows, and pigs. it's very different animals to where they've diversified and not saying, oh, we just have a bunch of different types of sheep. That's one thing that I think we need to understand and say, okay, well, that's the beef, but we also have something that was the completely opposite would be corn, for example. So beef prices go up, corn prices go, and then grain prices go down or in a different, but they're completely different products and not totally correlated. Um, that's one of the big things about understanding correlations. Regular review investments, important to regularly review and adjusting retirement plans. And that's always, make sure to, it's not a retirement plan is not anymore, is not a set it and forget it. We have tax policies that change with the Tax Cut and Jobs Recovery Act, the big beautiful bill. There's ages, there's time changes, there's health expense, there's health changes, family changes. Anymore, it's not like you do a step and say, okay, I have a retirement plan. A retirement plan is now more like a living document that has kind of come out with some projections, but it's kind of revisited and decided on how you're going to I envision it being something you continue and change as you adapt in life and maybe as your goals change, but you still are going in the same direction, but you might have to take some different make some different moves, but understanding what's going to happen off of those deviations and the changes that are expected. Personal advice, actually make sure you work with a well-qualified advisors. There's a lot of great fee-only advisors out there that do hourly planning and have great software. Virtual life events. Some of them may be very good at investments. Some people may be very good at cash flow and more of tax planning. Some people may be more into retirement type planning and more of that type of area. So there's different types of planners and not all planners, even if they have some of the same designations. Some planners might be very much into an insurance type field and use their asset. So it really depends on trying to get some different views and perspectives, and not all planners may offer the same solutions for the same type of problems, which is something that I think the industry definitely needs to look into. I think that's part of a problem is the professionalism of the industry is that they don't have the same answers for the same sort of for a retirement problem, which is something I think definitely needs to be addressed long term. Um, we also have profile your self-employment individual plan for retirements. Just a quick little. We have Lisa as a hypothetical example. She opens a SEP IRA and contributes 25% of her annual income. Its average is about 60,000. She contributes 15,000 annually. She has diversification of a mix of stocks, assets, bonds. And then maybe she's got some index funds, but she's gone through and done some modern portfolio theory and run it through some software, and she's doing some optimization for what she wants. Maybe she has like some dividend tilts. She sets up automatic money to transfer into her SEP IRA to her consistency. She reviews her portfolio annually and adjusts her asset allocation. And by age 60, her SEP IRA has grown. She's got consistent contributions. She's been doing this for years. She's achieved financial independence because now she can kick off enough of an income to replace her working income. And then all of a sudden, she's still got Social Security coming in, and she's going to be able to plan and model out her retirement and her expenses. Another example, different strategies. Let's say Tom opens a solo 401k and he contributes a maximum amount as both an employee and employer. He contributes 22,500 as an employee contribution and 25% of his compensation for a total contribution of about 50,000 annually. Roth contributions, he allocates portions to his contributions of his Roth options with a solo 401k and tax-free, and he's focusing on a tax-free withdrawals in retirement. He catch up contributions at 50. Tom took advantage. Let's say that he was earning, had planned to earn more money in Social Security in his income. So he might say, you know what, it makes me a lot better idea to do a Roth in my situation that models out. He does some catch up contributions of, let's say, 7,500 annually, and he's diversified to a broad range of assets, including real estates, REITs, and high yield bonds. 65 is accumulated, let's say 1.5 million. His diversification strategy significantly contributes to his annual allowable income. He manages his tax income and distributions and how he's handling that. So this kind of gives him a strategy. So it isn't the same way that everyone gets there and manages. They have their own individual strategies and what they fits their needs. Takeaway from kind of these scenarios is, make the big takeaways from this is start early, maximize your contributions, utilize the retirement plans that fit the situations that you've got. Make sure to look at the different ones, understand the pros and cons because they all have pros and cons of the different ones. Um, That's from accelerating taxes, decelerating taxes, how they're funded, if you have employees, how many employees you have, mandatory contributions, your cash flow, automated savings every time you can and pay yourself regularly review and adjust. And that just means, I'm going to go in, this is what our tax like. We're going to sit there and manage with our CFP. We're going to take a look, certified financial planner, for example, and you're going to be managing your taxes with your portfolios and making sure that everything is on tax. And then take a look to manage, leverage those tax deductions wherever you can. And then tax planning. Common misconceptions out there. Everyone says, hey, I don't earn enough to save for retirement. Well, you're going to have to, because you're still going to be retirement. If you're down to the point where you're not saving enough to earn enough, maybe there's savers credits that you qualify. A business can be a retirement plan. Well, what happens if you you have an aneurysm, something happens, you physically aren't able to work, a health event, something else could happen, you get sued. It's you start to say me to start saving. No, it's not. Everything that you can save now is to help. You might have to work a little bit longer and keep saving, but try to give yourself a cushion that you can. Um, so, what are the best retirement plans for savings and the best retirement plan for your self-employed individuals? And the answer is it depends. It literally does. It depends on your incomes, your saving goals, your business structure, a full one step IRA, a solo 1K, a traditional 401K. It really depends. A defined benefit plan. It really depends on what some of your needs, goals, in your business are. Can I contribute both to a SEP IRA and a solo 1K? Yes, you can contribute both, but the contributions across all plans must not exceed the limits set by the IRS. How do I decide between a traditional and a Roth contribution? Traditional contributions reduce your taxable income now, while Roth contributions are taxed now and allow your taxes to grow. This is one of those ones where I love to say there, if you know you're going to be in a lower tax bracket in retirement, it's a really easy an answer. If you know you're going to, or a higher tax bracket in retirement, the easy answer is do pay the taxes now at the lower level. If you know for a fact you're going to be in a much lower tax bracket in retirement, then it's pretty much to say, you know what, maybe it is a lot easier to defer your taxes until retirement and pay them at a much lower rather than a 22%, pay it at 12%. So it really depends on what you're, and if you're so far from retirement going, I got 25 years or 20 years till I'm going to retire, but I have a successful business now, you need to sit down, have a real discussion and say, maybe I do something that's a 50-50. What does make sense? What is my family needs and what is my goals now that I'm planning for 10, 20 years out? And what do I put myself into a position to give myself flexibility to deal with whatever situations arrive? Or I'm really personally, I want to put everything, don't want to pay the taxes now, or I want to pay the taxes now. But you need to run some software and some financial numbers to kind of figure out what kind of experience you would have with that. Conclusion. This has been kind of a quick little discussion to kind of go over some of my thoughts on retirement plans, details of some SEP IRAs, solo 1K, and SEP IRAs. The tax benefit retirement plans, including tax deductible, tax deferred growth, Roth options. I also think people need to look at there's some benefits in case you have to go, the protections that are offered inside 401ks, inside tax qualified plans, as long as you've made sure to make continuous regular contributions to those to help protect you in case something bad something happens, that there is some protections on some of those accounts. Now is the time to control your future. I hope this gives you a little bit of an idea. You can check out things like Fidelity, Betterment, Personal Capital, Mint. Make sure to understand the IRS, talk with your financial professionals, and make sure to have a good discussion about the different options that might fit you. And if they're not able to your answers, interview a couple different planners that might be able to give you a good idea. And with that, have a great day. Thanks a lot.